Finding the highest probability trade setup in the market is perhaps one of the biggest priority as a trader. And an underrated factor to doing this is being able to identify the right key level. Most traders, when it comes to identifying key levels, look at it from a support resistance standpoint. And there are a lot of things that are not talked about, from an education standpoint, some of the things that are important to identifying key levels, because when you can identify the right key levels, right, that means that you can put yourself in a position where you're taking advantage of price at the right time and putting yourself in a position where you can take advantage of the highest probability trade. In today's video, that's essentially what we're going to be getting into, how to identify key levels and some of the things that you want to pay attention to when it comes to identifying key levels. Let's get right into it. A common mistake that I see a lot of traders making when they come to the market and they're trying to plot your key levels, even I made this mistake for many years, is plotting your key levels within your execution time frame. In trading, you have time frames where you are getting the large perspective, the big picture. You have big picture time frame. Big picture time frames are usually 2 time frames above your execution time frame. Your execution time frame is where you are looking for low risk entry on your trade. You're looking for price to get that reaction on the key level that you've gotten from your big picture. But the common mistake that a lot of traders make is that they plot your key level in the execution time frame. So if you're trading on the 1 hour time frame, in this example, we can say that price has bounced off this area before in the past and we've taken out this high. So there's a strong possibility that we're also going to be pushing to the upside again, because this key level held before, or you can say this level held before. So there's a strong possibility that will likely hold again. So we take a long position here and we look to see if the market is likely going to be pushing to the upside. And what we see as price continues to move is, okay, price is going your way, and all of a sudden price takes you out because you haven't plot your key level at area that is strong enough to cause a major price reaction. So one of the things that I realized when you're plotting your key levels is you cannot pay attention to the time frame that you are going to be executing from. The number one standard when it comes to identifying key level, guys, is you want to use 2 time frames above your execution, and generally the daily time frame is perhaps one of the best time frames to get your key levels from. So when it comes to plotting your key levels, you definitely want to make sure that you are paying attention to the daily time frame. Whether you are a scalper, whether you are a swing trader, you want to gain the large picture from the daily time frame. It is super critical. So in this example, GJ, we're on the daily time frame. You want to start to look for areas on the chart where price has had a couple of major reaction. That is why we call it key levels. And what we can see here with this example is that just by looking at the chart right now, we see 1, 2, 3. Every time price hit this level, we saw a pretty significant drop to the downside. And every time price hit this level, boom, same thing. And the next thing you want to do too is you also want to take it a little bit further. You want to look to the left. It's always important as a trader that you look to the left to see what's happened before. So we can see that even the reason why price bounced and started pushing down is because we hit a key level, a key resistance level, and we can see the exact same thing here. So when you are looking to trade, or maybe you were in a long trade, this area would have been an area to pay attention to. But since price is now trending back down, we are now paying attention to areas on the chart where we're likely going to be seeing a bounce to the upside. So we can see that this level is a very similar level. We've seen price pretty much reject, hit this level from the buyer standpoint. Buyers traded up to this level, failed to close above this level, and we saw a pretty significant rejection. One of the things I want to point out too is the key level isn't just one level on the chart. It is a combination of different areas where price could reject from. So a lot of the times traders will say zones. So if we go back right where we are, and what we see here is that, okay, price is trading its way down here. As a trader, what you want to do is you want to identify an area on the chart where price is likely going to reject. And what that means is you want to pay attention to certain just zones, certain areas, because when price rejects, price hits a key level, it's not just going to bounce off the line. It might trade past it and then give you the bounce that you're looking for. So once you've done that on the daily time frame, right, the next thing you want to do is you want to go over to the 4-hour time frame. Pay attention to the 4-hour time frame. Okay, take a look and see some areas on the chart that, hey, you know, price is likely reaching for. So when it comes to identifying key levels, you can take a look at areas where price is giving you rejections. The other thing I also like to pay attention to on the way there is the lows, right? So I'm looking at areas where price is likely going to be reaching for, areas of liquidity that price is going to be tapping as it makes its way towards that key level, because when sellers are in control, they are targeting lows, right? But it's important that when you are focusing on the highs and the lows, you're also mapping out key levels where price is likely going to be rejecting from, because when the market is done taking out the highs, or in this case taking out the lows, what's going to cause that reversal is a powerful key level. And right now on the daily time frame, we have an area that is mapped out that we can likely say, hey, has the potential to cause a price reaction. And let's see if it actually does. We start to scale down to a lower time frame. And if you're going to be executing on the 1-hour time frame, this is what you're paying attention to, right? You scale down, you have areas, you can even take a look at this area and be like, okay, now these are minor key levels on the 15-minute time frame. You already have the big picture time frame, right? Key level. You can also change the color of that area, right? So we can also call it a zone, because it is no longer a particular level. It is now a combination or a range, right? So we know that between here and here, this is where we're going to be watching for price to reject. So let's go back over to the 1-hour time frame just so we can start to, we can gain a better perspective of how price is moving. So now we can see that, hey, price is traded over to our key level. Another mistake a lot of traders make is when price hits a key level, they just get involved in the trade. Boom, I'm going to set my stop loss right here, and let's see how the market goes if price is going to be going back, up into this area, because guess what? The market is in my key level. So boom, right? You do that, you get stopped out, within the next hour. One of the things that you have to do as a trader is to wait for price to break below those key levels. The best key levels, price break below or break above them, and you simply wait for that. You simply go on the lower time frame, okay? You wait for the momentum to start dying out, because we have very, very strong bearish momentum, right? So when price is doing that, you want to wait for price to get exhausted. Try to break the key level multiple times, and we see this long candlestick. We failed. So let's, and boom, we're seeing price push, break lower, break lower, break lower. We're seeing price even trade past that key level, and you might keep selling, thinking that, hey, you know what, the market is going to keep moving lower. But now we're seeing price is essentially breaking above that key level. So on your execution time frame, it might look like the key level didn't hold, right? Because wow, price broke past that key level, probably I'd say 50 pips, right? Even 150 pips. But because you gain the picture from the daily time frame, it looks a lot bigger. So what you're doing now is waiting for price to break below the key level and then break above it allows me to take advantage of the price action, because the next thing that we've seen is market structure. We've seen price break this market structure, which has now shifted from a seller standpoint into a buyer's market as price has taken out this market structure. So best thing that you can do is wait for the market to come back down. So now we can say that, okay, you know what, price is going to be breaking above this key level, and we can now place a stop loss right here. The range is relatively big. It's 40, 50 pips. You're doing it on the 15-minute time frame. you can simply look to take price over to the next area of interest, right? Or you can even take price as high as you want. Obviously, you want to be cautious of, your risk, but because it's a critical key level, we know that we can expect a big push to the upside. So let's see how that, what happens. Market comes down and we start to see price move our way, and pretty much, let's see. Boom. So if this was our first take profit, it was targeted, it was hit. And on the 1 hour time frame, we can see how price reacted. So a key level, the one thing I want you guys to understand when it comes to plotting your key level is you're looking for an area in the chart where price has rejected the most, right? Where price has tested. So if you take a look at the daily time frame, you're looking at an area where price has gotten the most rejection. And you can do this on the lower time frame as well. You can do this on the 5-minute time frame. When you are doing it, you're keeping account of the market structure. You're also paying attention. You also understand that a key level isn't just a particular level on the chart. Based on the first example I've shown you, a key level is a zone, right? Key levels can be zoned. It's not just one line. If you're waiting for one line for price to reject off of that one line, it will be very difficult. So what I like to do is I like to give myself zones, and I like to wait for price to break into a particular zone. Broke into it, the momentum shift from sellers, and we start to see more buyers come into the marketplace. And that's simply what you're looking for. So when it comes to identifying key levels, you want to look left. You want to collect your key level from 2 time frames above your execution time frame. And that's the video, guys. Thanks for watching. Hope you found this video insightful. If you have any questions, feel free to leave a comment down below. On your way out, don't forget to hit the like and subscribe button. I will see you on the next video. Hope you're out there living free. Cheers.